Welcome to Second Take, the show that focuses on the issues behind the news. South African iron ore major Kumba Iron Ore has taken the knife to over 1,700 jobs as new iron ore prices cut a swathe through the industry. Mining Weekly editor Martin Creamer tells us more. Welcome, Martin.
Thanks, Shannon.
Kumba presented with 61% lower headline earnings for the 6 months to June 30. What impact has this had on jobs for the iron ore miner?
You know, this is the cash cow of the Anglo American group. This was the dividend payer from inception. Now they've ditched the dividends. Their earnings have plunged. They're rejigging mining and they're cutting jobs. You know, they turned 2 years ago 6,000 employers into half millionaires because the employees were cut into the business. They were shareholders through an employee share ownership scheme. We now have no more dividends flowing to them, and you know, if you calculate it all up, you know, since inception, I think they put like 25 billion rand into the community. So the community has been used to getting like 500 million rand a year. This is all gone. You know, the government's been used to getting a lot of taxes. This is gone. Anglo American Group has been used to getting those dividends. So it can also, you know, talk about dividends from the main central group. Everybody's saying that's not going to happen. And so we'll see on Friday whether actually they declare a dividend, the Anglo American Group itself. But it's jobs negative at the moment, and they're having to deal with a price which is quite sobering. You know, $45 a ton. That's one of their new break-even level. You know, they used to be at the heady heights of $135 a ton only 2 years ago, and as we say, just everything was going right. It was like Toyota, but now everything is going wrong. And they have started their job cutting at the top. So it's the new trend these days. They look for head office jobs and they say, these are the high paying jobs, we've got to go for these first. And they chopped out, you know, 200 million rands worth of jobs, which was like 351 people out of the head office. And now they've actually ditched a mine called Tabazimbi, which had been planned for long-term growth a year ago. I think this time last year they were talking about possibly rejigging that into a mine that would have long-term growth. There has been a sidewall collapse and there have been all sorts of disadvantages there, and they've just taken the opportunity to close. But with that, you know, it goes like 1,160 jobs, you know, 800 people that are directly employed, 360 that are indirectly employed. Every single job loss has a ripple effect throughout the economy. Every cut back on capex, and they're cutting back on capex severely, has a ripple effect. You know, they're going to buy fewer fleet vehicles because they're mining differently. They're looking very much at the lumpy ore because they get a premium price on that. The sort of the removal of earth to get to the ore, that's slowed down and gone into a different mode. So you don't also need as many houses as you were planning. They were building a lot of employee houses, and because things were going so well in the area, you know, you couldn't get a house there. So the mine had to actually build a lot of houses. Dingleton project, which is the housing scheme, will go ahead because they feel they can't stop it, you know, midway. But you're going to see them getting more employees put into houses in Katu, and where the other opportunities exist because of the downturn now in that area. Suddenly there's more opportunity to get housing. So it's amazing how quickly things can turn, and you just look at it and you realize that some of the biggest businesses in the world are in this iron ore business. You know, you've got BHP Billiton, you've got Rio Tinto from Australia, you've got Vale from Brazil. They've got intelligence officers. They're looking at this market all the time. Everybody's looking at it, yet it can catch you by surprise. And this whole business about being a price taker is quite painful when things like this happen. And for the South African economy, it's pretty bad because, you know, we really already have a big unemployment rate. You don't want to actually exacerbate it, and the ripple effect is so great that I think all of us are going to feel it. We can see the steel industry at the moment is just not moving. Well, iron ore supplies steel. You know, if there's China not using all the steel and putting it into our market, then we're not producing steel here, then even the domestic supply is going to be impacted, or it's at risk. We see Evraz saying, look, it's no point in us making any more steel. We can't sell it. It's just too costly. And steel is that primary element within any economy. You know, the demand should be there. Then you know there's growth. When your steel mills start closing down, you know you're in quite serious trouble.
Now, CEO Norman Bazima says the company has to work doubly hard to be able to compete in the markets that it's faced with right now. Can you elaborate on that?
You know, there's another thing. The Australian iron ore producers are closer to China. China's the main market. So just the logistic costs alone, to try and compete with that is difficult. They claim they're far further from the port as well. So the rail costs are a factor. Rail has really done well, but at a cost. You know, our tariffs are quite high. We've had a tradition of high tariffs here. So they've got to then deal with that. So they're saying their only advantage is the lumpy ore. So it's very good, but you can probably not earn more than $2 to $3, you know, a ton on that premium. But your other costs are different to your competitors. So you've got your rail costs, which are high. You've got your freight costs to mainly China and the East, which are higher than your competitors. So suddenly your competitors get in there before you do. And Europe isn't really buying the way it used to. So, you know, the traditional closer markets, I suppose they should look to India and hopefully get more out of India. But at the same time, it's hard to compete when, you know, your rivals have got that advantage over you, that competitive advantage, and demand is down.
When you're just physically closer.
Exactly.
Now, on the other hand, Anglo American Platinum, meanwhile, saw profits soar 704%.
Yes, and you know, that was against the background of the 5-month strike. So, you know, it's a sort of a difficult percentage to clap about because, you know, you've got to work out what is normalized. But I think their results were sound. There's no doubt about that. You know, in difficult circumstances, I think that they can pat themselves on the back. So that situation of having a solid base and their financial situation improved as well. Their debt fell, and they're also watching every penny that they spend. They are definitely in a better financial position than they were before, which is interesting in that difficult platinum space as well, because there we see the price, you know, falling below $1,000 an ounce, which one didn't anticipate. And you wonder how this happens, because you know that demand is up. I mean, if you look at just catalytic demand throughout the world, there were more light-duty vehicles sold in the world year on year. So you would imagine that, you know, this would underpin the price. So it's curious about these markets, because you can have the market fundamentals not looking unsound and even growing, even if marginally they're growing. Yet you have the price fall. And it's because of these macroeconomic conditions, you know, in the world, prevailing in the world at the moment, the uncertainty. People decide to pull in their horns, and it has an impact on the platinum price all of a sudden, even though the real demand has not fallen. It is actually slightly up, and it looks like there's a slight deficit or a balance. So it doesn't make supply-demand sense. It's just the macroeconomic sentiment that is dragging it down.
What about recyclables?
You know, recyclables, again, there's not as much recyclable material coming into the market, which is again a plus for the supplier. Because now, because the price is down, you know, people are holding on a bit to it costs more to bring in that recycled material. So there's also that consideration. And they're saying, well, you know, don't sell now, because maybe it'll be better in the future. Obviously, they could reach a point where they have to sell, which will be terrible, because that's like a fire sale, and that can pull things down. But at the moment, there's at least a bit of relief from the recycling. So one would again say that's a fundamental that should be helping the price of platinum, yet we see the price of platinum falling because of these macroeconomic conditions.
Now, finally, what effect could mechanization have on Anglo's jobs and production? Yeah,
well, you can see that they want to move towards mechanization at 100% level. I mean, at one stage they said, okay, these are the mines we've chosen to keep, and among them was Amandelbult, which at a certain stage they said, no, well, we won't mechanize that because it doesn't lend itself to mechanization. They're changing their tune slightly, saying there, you know, they're saying, well, even Amandelbult, you know, we've got a solution for that could be a mechanized solution. So they definitely want to move into that space of lower people intensity, labor intensity dropping. And that is always something that has frightened investors in the platinum industry. You know, I can remember even BHP Billiton at one stage wanting to go into the platinum industry. But when it looked at the number of people per ounce, it would be so different to the ratios in BHP Billiton that they said, well, we'd love to get into platinum, but not at that labour intensity. So you can see now the restructuring of Anglo American Platinum, how they're moving away from being labour intensive to being capital intensive. That obviously has an impact on jobs. It must do so. And the hope is that there will be a balance in that you create some jobs in factories and you create maintenance jobs and you create other jobs which are higher level and higher paying. And that's why I think there has been a call for these particular pieces of equipment that are very specific to South Africa to be made in South Africa, possibly for Southern Africa, Zimbabwe, the same sort of situation, and for also spreading into all underground mines that have got low stope heights. And so, but we don't see actual evidence of that in local manufacture, or we don't see our own South African original equipment manufacturers actually getting the business at the moment. But it would be great if the jobs you lose in the mine you gain in the factory, and they are better jobs that have got a longer horizon with bigger pay.
And safer.
And safer. And of course that is the primary move as well. It's terrible to be a CEO of a company and your people go to work and they die at work. I mean, it's like heartbreaking stuff. So the safer you can get your mine, the better it is for everybody. And this mechanisation does bring safety with it as well.
Well, thank you very much, Martin.
It's a great pleasure, Shannon.
That's it for today. Join us again next week for more news analysis on South Africa's mining industry.